This episode of the Matt Feret Show is brought to you by the Brickhouse Agency. Brickhouse is a boutique independent health insurance agency that focuses on finding the right Medicare coverage for folks across the country. Matt's wife, Nikki, is the heart behind Brickhouse. She's great at making confusing things clear and is passionate about helping people find a Medicare insurance policy that suits their individual needs. To schedule a free one-on-one appointment with Nikki or a member of her team, head on over to brickhouseagency.com or simply call 844-844-6565 and someone will help you schedule a phone call or a Zoom meeting. The consultation is free because the insurance companies pay Brickhouse, not you. There's never any pressure or obligation to enroll. Your clearer, simpler Medicare journey is just a call or click away. brickhouseagency.com. Not affiliated with or endorsed by the government or federal Medicare program. Contacting Brickhouse Agency, LLC will direct you to a licensed insurance agent.
Hello, everyone. This is Matt Feret, author of Prepare for Medicare and Prepare for Social Security Insiders Guidebooks and online course training series. Welcome to another episode of The Matt Feret Show, where I interview insiders and experts to help light a path to successful living in midlife, retirement, and beyond. Welcome to The Matt Feret Show, practical conversations to help you thrive in midlife, retirement, and beyond. I'm Matt Feret, author of books and courses on Medicare and Social Security, and a former healthcare executive with decades of insider experience. I use that experience to help people make clearer, smarter decisions about health, wealth, lifestyle, and caregiving. Each week, I sit down with experts, insiders, and fascinating people to explore what it really takes to thrive, finding purpose, building stronger relationships, and creating a sense of meaning and community in the second half of life. Together, we'll light the path towards your wealth, wisdom, and wellness. Welcome to the conversation. Hey, everybody, before we start today's conversation, I want to take a minute just to set some context, because this is one of those topics where people often have a reaction before they have information. When you hear phrases like selling a life insurance policy, it can feel uncomfortable. Some people associate it with late night commercials or aggressive financial tactics, or the idea that someone might be taking advantage of a vulnerable situation. That reaction is understandable. And it's exactly why conversations like this one matter. Because what most people don't realize is that life settlements are not a loophole or a gimmick. They've existed in U.S. law for decades and are regulated primarily at the state level with licensing requirements, disclosure rules, and consumer protections overseen by state insurance departments. Like many financial tools, this space has had bad actors in the past. I don't think you can pick any part of money and people and you're not going to find a bad actor in there. And a lot of times, unfortunately, those moments shape public perception. But regulation, transparency, and professional standards have changed dramatically over time, largely because industry leaders have pushed for stronger oversight rather than less oversight. So today's conversation is not a sales pitch. It's an educational discussion about options that already exist, all legal, and that some families may want to understand long before they're ever needed. You may never use this option. Most people won't. But understanding it calmly, clearly, and without pressure is how you make better decisions and avoid being boxed into choices you didn't even know were on the table. And that's why we're talking about it today. My guest today works in a part of the insurance and retirement world that most people never hear about unless they're already under stress or facing a major financial decision. He spent more than 3 decades in the life settlement industry, where policy owners may have the legal option to sell a life insurance policy they no longer need or want or can afford, often for more than the cash surrender value, but less than the death benefit. Over his career, he's been directly involved in negotiating and settling thousands of policies. He's also played a significant role in shaping industry standards, regulation, and consumer protections, including serving as chairman of the board of the Life Insurance Settlement Association. He is often referred to as Mr. Life Settlements, not because he promotes this option indiscriminately, but because he's been deeply involved in defining what it does and what it does not, and when it does and does not make sense. My guest today is Rob Haynie. Rob, welcome to the Matt Feret Show.
Great to be here, Matt. Thank you for that great introduction, those kind words.
Well, for people meeting you the first time, tell everybody what you do, how long you've been doing it, and how you found your way into the life settlement world.
It's a good story. 1993, August of, I'm at the gym, which reminds me I need to go again. And a gentleman that I knew was pretty good in sales came over to me and he started to pitch this idea that he was helping people sell their life insurance policies that were dying of AIDS. And of course, my
Ooh.
initial reaction was, that's the most ghoulish thing I've ever heard of in my life.
Right. I just went, ooh.
Exactly. You did the same thing I did. And I said, this doesn't make it. It's not for me. So I finished my workout, got in my car, and I no longer sooner got to the first traffic light on my way home to where a light bulb went off in my head. And it said, wait a minute. You'd be keeping the insurance company honest because they could get cash out of their life insurance policy. And at the time, those individuals were using it to get medicines that weren't readily available. They weren't FDA approved. Maybe heard of the movie Dallas Buyers Clubs come to mind.
Yep.
They use those cash, and in many cases, are alive today because of it. So that transitioned from what was then the viatical settlement industry to the turn of the century. Weird to say that, but around the year 2000, this kind of swung in the other direction, became the life settlement industry. And that's a big difference there is that we're helping seniors, people 65 years or older, selling existing life insurance policies, as you mentioned, that they don't want, they don't need, or they can't afford. So they're deciding they don't want it, they don't need it, can't afford it. So without us, the options are lapse or surrender. So when you think about a life insurance policy and a cash surrender value, that essentially is a life settlement offer by the carrier. That's their only offer. It's non-negotiable. That's what it is. You take it or leave it. It's up to you. Along our industry comes and says, wait a minute, we'll go out to a whole litany of different type of accredited investors, pension funds, et cetera, who will buy your life insurance policy based on your mortality in their mind and give you a cash settlement today that you can use for what you want to use it for, which in this case, in many cases, is retirement, to retire more comfortably, whether it's to age in place and retrofit a home, whether it's to move into a facility for memory care, et cetera. It's your option. It's your money. You can do it. So there's no pressure. We call it a free non-binding appraisal. This is not something we tell you that you should do automatically, as you mentioned, but it's something to compare to the other options you have. So if the other option is, I've got a rich uncle that'll pay my premiums, that may be the better way to go. But we're there to provide answers rather than just to say to you, oh, your only option is to let the policy lapse or to surrender for the cash surrender value. So that's really the way it's morphed. We are a financial planning tool. We usually go to financial planning, financial advisors, estate planning attorneys, and kind of guide them into a position where their clients come to them with all this life insurance they've bought over the course of their lifetime. In many cases, they bought way too much. Some of it's performing like it's supposed to, and other policies, quite frankly, they should have never been sold to begin with. Must have been a trip involved, which is why they bought it. So let's get rid of that policy. Maybe we take the cash we receive out of the policy that's underperforming, and we use that to pay down what we owe on the other policy to make the premiums more affordable. But those are all things that the financial planner and the individual considering selling their life insurance policy gets to talk about. We don't get involved in that. We do our job, then we get out of the way. So if that answers your question,
It does. Thank you. So I'm going to ask about the terms, and I know
Sure.
You're in the life insurance industry. I've spent a long time in the insurance industry as well. So I'm sure we're going to be throwing out insurance terms that you and I both know for decades, and people listening going, wait, what is that again? So I'm going to get to those. But before we define terms, why do you think this topic makes people uncomfortable or skeptical when they first hear about it?
Well, it's another great question. First of all, I'd like to say that about 90% of the country doesn't know what this is.
Yeah, right.
They just don't know. The commercials run on TV, whether they're late night or during the day, the news channels, et cetera. If you don't know what the word life settlement, the words life settlement mean connected to each other, That's just noise that's on the screen. It's going by you. So we're trying to create a situation where people are educating their clients. So you talk about the folks that listen to your show. They might have parents that are in the same situation, that they've got life insurance policies. And if you're not talking to them about that, they may go ahead and cancel the policy and never to have a conversation with you. And that's money you've left on the table. So there's not enough sellers, if you will, for the number of buyers that exist out there. So it's an education deficit is what I call this. So why do people get nervous? Because the first instinct is like, I'm being taken advantage of. Someone's
Yeah.
taking my life insurance away. Well, let me give you another reason why that's not true. Without me, 90% of every life insurance policy that's ever been written will never go to claim. 90.
Wait a
That's
minute.
we
I always joke around that
90%.
life insurance is literally the only type of insurance you're guaranteed to use. So, right?
Well, think
Because
about it.
we're all going to meet
Think
our
of,
maker, but you're saying because of the lapses and the people just giving them
yeah,
up and no longer paying premium, is that why that 90% number is
that's
there?
well, twofold. When most life insurance, the bulk of life insurance is sold in the group employer scenario.
Oh
So when
yeah.
I get out of college and I get my first job, let's make it up, ABC company, I worked there for 3 years, and then I get a better offer from DEF. I had life insurance for those 3 years I was there. I could literally take that policy with me, portable, and pay well, guess what? It's a lot more expensive to do that, so they let it lapse. They get another policy. And this continues on through the cycle until maybe they buy their own life insurance on their own. So that's most of the life insurance that gets lapsed. But the other is that people buy life insurance and then they get down the road and then all of a sudden they say to them, hey, your premiums are going to go up next year because you're 65 or 70, whatever the number is. In case of a term policy, you have to convert it at age 70. That premium now you go to a permanent policy, it's now 5 or 6 times as expensive. People are like, wait a minute, I don't want to pay this. So they let it go. If they knew there was an option before they did that, they might go out to a company like myself or many others that are part of our industry and say, is there a possibility someone will give me more than the $36,000 I'm going to get when I surrender the policy? And hopefully there is. But guess what? If you don't ask, you don't know. And if you find out there isn't, at least you can sleep at night knowing that you tried and looked. So that's really what we tell people. Don't be afraid of it because you don't have to take the money. We can give you the money and you can take the money actually and have it for 14 days. And if something's not sitting right with you, can unwind the transaction, give the money back, and you get the policy back. That never happens, but it's peace of mind for the consumer to think I'm not trapped. I didn't make a hasty decision. The hasty decision is letting it lapse and then finding out 2 weeks later because you know what the commercial means now and your policy's not there to sell.
And thank you. And one last question on this topic before I get into
Sure.
the details of it. You mentioned marketing, right? And I did at the onset as well, the late night TV commercials. Has the feeling or the lack of awareness, or if they're aware, I guess the smarminess, lack of a better phrase, is it because of the marketing or is it because of past bad actors or just confusion? What is the feeling behind that? Why people are either unaware or B, if they're aware, it's a middling to negative connotation.
So I would say all three, honestly, because everybody's going to be in a different bucket. But the answer is if you knew about the industry prior to this industry, the problem was, and the bad taste that left people's mouth was investors were buying those policies of people that had HIV and AIDS. And virtually overnight, they're not going to die anymore. So that's a bad investment. You've invested in a
Well,
policy.
yeah, good
Okay.
outcome, but bad investment.
Good
Yeah.
and good. Somebody won, somebody lost. So that's one of the bad. Now we're 25 years past that. So right now, there's really not a negative connotation. Life insurance carriers like to paint one. They'll say things like, and since I'm on your show, I'll just tell you, they'll say things like, well, you never know who's going to shoot you. They'll say things like that. Literally say that, like to the client, like you could get killed. Well, you can get killed by anybody for any reason. However, if you think about the effort it would take to solve that crime, the person buys the life insurance policy. It's with that transaction, that's one of the things they're going to look for. And all of a sudden, 2 days later, Mr. and Mrs. Smith has passed away suspiciously. They're on your track. They're going to find you. Guess
Yeah.
what? It's never happened. Same thing I used to say, on panels with carriers, and they would kind of bring this up inadvertently. And I'd say, that reminds me. So if I bought an annuity from your company and I gave you $1 million for a SPIA today, and you ran me over tomorrow, that would mean you'd make $1 million. He goes, we would never do that. I said, well, touche. That's who's buying the policies today. These are large pension funds. Nobody's into that game. But those are things they like to put in people's mind to make them not keep the policy in force. Their goal is to not pay death claims. Think about a business model. How I could prove this to people is I say, go back to 2008, 2009 and the financial crisis. They handed out TARP money to all the investment banks, right? How many insurance companies got TARP money? None.
Yeah. No, they let AIG fall. Yeah.
And AIG's whole bucket inside of that was their insurance division. That was the healthiest part of their entire operation. All the people that bought all those crazy investments, right? The mortgage-backed securities, the bespoke tranche opportunities, whatever they call them, those were garbage. But the insurance companies, as you all know, they're the healthiest corporations we have. They don't buy anything other than real estate. It's really all they buy. I mean, they always go look them up. Go into any city you fly into, and you'll go down and look at the buildings. And if you ever had some free time in the hotel, look who owns each building, and it's all insurance companies.
Yep.
So they're healthy.
I agree that
which is why
a number of years ago said basically the same things. That you ever want to look at the, a good snapshot of the financially most healthy / has the most chance for longevity, look at the names on the marquees of the tallest buildings in any city you're in. And so I started looking, and you're right, it's banks and insurance companies.
Or my other friend says it's the same exact analogy you made, but he adds center field neon signs in baseball stadiums. They're there.
I'll start looking there now.
And they're there. And so
all right, so let me slow this way down just for a second. So plain English, what is a life settlement?
A life settlement is a sale of a life insurance policy that you currently own, or the insured, your family member currently owns, that they no longer want it, they no longer need it, and they can no longer afford it. And that is now sold to a third-party investor for a price, as you mentioned in your introduction, somewhere higher than the cash surrender value, or in the case of a term, zero, and less than the death benefit.
And what problem does it solve for someone who owns a life insurance policy?
So if they had a life insurance policy that, go back to the fact they don't need it. They don't need it, but they have another specific need. So I use the word aging in place has become a big topic that we've discussed it for last year.
Oh, yeah.
They want to keep the home. They also want to keep the home and retrofit it so they can age in place. So there's going to be ramps, and doorways are going to be expanded in case of a wheelchair, the bathroom, all the things you see on TV for walk-in tubs, all of that takes place. Now the home is set up for, you're fine now, just as it is, and as you start to need care to come in, they can come into the home and you never leave. The most important thing that does is the asset, which is that house, stays in the family. You're not selling it, taking that cash and handing it to an assisted living facility, which you don't own anything there. They just take the deposit, and if you live 25 years, they almost look at it like an insurance policy. They just figure out the average age of their person that comes in, how long will they live, and how much money will they be able to keep. So this gives you options. I keep saying this all the time. This is not, you don't have to even know where you're selling the policy. In case of unaffordability, you don't have the money to pay for it. So what are your options without me? Lapse it, surrender for the cash. And now I come by and say, okay, you're going to get $36,000. Here's $180,000. Which is the better option? So now they have $180,000, and they can use that for whatever they see fit. We have clients that buy cars and you literally drive across the country. That's what they do with their money. It's their money. They're set up for everything. They got everything else covered. They just don't want to pay that premiums. The kids have grown up. The house is paid for. There's no need for that policy anymore, especially now that they've increased the premiums on them dramatically.
So why do so many people let policies lapse? In other words, they don't pay them and they just let them expire, or they surrender policies without realizing other legal options exist.
Because they don't know. Lack of awareness. They just don't know. So when you buy most life insurance, you have a life insurance agent. Most life insurance policy owners are orphan policy owners. They've either been adopted by the next stage in the queue at the office, or if they amass a larger net worth, they bring all their financial assets with them to see them. Most of those people, those financial professionals, believe it or not, won't even ask their client if they have any other life insurance. Won't even bring it up. So we try to teach people to say, make sure you're asking that question. Gain control of that asset. You want to be on the record as the agent of record. You want to get all the lapse notices. You want to be aware of all of the options that exist around your client. So we ask those questions. So that'd be the easiest answer to give you there.
Okay. And what types of policies does this work for? You mentioned earlier term, and I'm not a life insurance salesperson, but term is you basically rent insurance, right? You get a 30-year term, it's a fixed rate. You say, if I die sometime between point A and 30 years, I get $500,000 worth of life insurance. It's $1,500 a year, whatever it is. But there is no cash value on this. You're just literally renting insurance, which is the most popular and a lot of stuff you see on TV, right? Can you do this with term? I wouldn't think you could.
Yes, you
Really?
can. Here's why. So if you're 66 years old, let's give you an example. $1 million term policy that's going to expire at age 7, which is when most people just let it go. They just don't do away with it. The buyer sees that policy for a couple of reasons. One, he's going to, if you have a long life expectancy, he's going to pay you very little for the policy, but it's more than you're going to get otherwise because you're going to get zero, whatever that little means. But there's a conversion commission that's going to be generated when they convert the policy to a universal life in most cases, sometimes whole life, mostly universal life. That commission allows that buyer to manufacture an offer. That's how I could be compensated. That's how the seller could get their money plus some money from the buyer. And they'll try and amass as many of those longer life expectancy policies as they can and consider they're all going to go and live 20 years. And you say, who's going to want to buy a policy or policies that aren't going to do anything for 20 years? And I mentioned pension funds before. Their liquidity needs are so far off in the distance, they like buying this life insurance policy as an asset, alternative asset, if you will. Here's why. It's uncorrelated. When the market goes down 3,000 points or 15 points or 6,000 in a week, whatever it is, chaotic financial conditions, what happens to the policy that they own? Death benefit stays the same. The life expectancy on the insured they bought it for stays the same. The premiums stay the same. So it's stable. They want to buy as much of this as they can. And you're buying A++ rated paper. It's commercial paper from the strongest financial institutions on the face of the earth, the United States life insurance industry.
That makes a lot of sense. I didn't think about it that way. Let me pivot just really quickly. By the way, you can go whole life insurance too. So if you've got a whole life insurance with cash value,
you can do whole life. Whole
work?
life is harder. Whole life is the least purchased policy because people don't really sell them as much as other people because they tend to be working better. Yeah. Honestly, they just do. They're harder to track down in terms of what's going to cost premium wise to keep them going. It's not really a policy that the appetite for it is great. We can sell them, but typically people that are a little bit more impaired than others, someone with a shorter life expectancy, maybe 10 years, 12 years and lower.
And then permanent, that's the third and basically last kind, right?
UL. That's GUL, IUL, UL itself. Those are the most bought, most sold policies in our industry.
Okay. And at what point does this normally conversation come up from your standpoint? You say financial advisors who know it, or people who are just looking for options. Does it come up around quote unquote retirement or health changes or caregiving needs? And does it come up with, people like me who've got, an older parent that may not know about this stuff? Where does this stuff normally come up?
Well, Matt, you're great at asking questions where you've answered all the answers. So every one of those scenarios.
I didn't mean to do that.
No, I mean, that's good. I mean, you're being true. I'm being truthful with you. Those are, you never know. I mean, every life insurance policy that I look at is a snowflake. They're all different. It could be the same age person who lives in the same town with the same policy. And trust me, everything's completely different when we go and analyze the policy. So when does it come up? Hopefully it comes up from when we talk to our advisors that they're conditioned to be on the lookout for annual policy reviews, any inconsistencies in the answers they get from the clients in terms of their overall ability to continue to pay those premiums. Lapse notices, grace notices that show up in the office because I told them to become the agent of record. They're getting alerted to Mrs. Smith hasn't paid her premium. Is she going to pay it? Those are that's a sign of trouble. So that's what we would do. Or the client will come to you and say, oh, look, I don't want to buy this. COVID taught me one thing and one thing only as relates to my industry. Life insurance is a luxury. Okay. Nobody is sitting there going, I'm got this Hancock needs this money, but I also got to eat. I'm going to give Hancock the money. They're not giving Hancock the money. They're buying their food. They're buying their medicine. They're paying their rent. They're paying their mortgage. They're paying their car. They're paying their insurances for the things they do every day. And life insurance was getting thrown away. Now, COVID was a double-edged sword because everyone thought they were going to die. So like, how do I keep the policy? How do I keep the policy? And if they couldn't keep the policy, selling was an absolute option for them because now they had cash. So we can also do along those same lines is we can split a policy in half. So if they got a $500,000 policy, they can keep 250, sell 250, or we can have what's called a retained death benefit. You say, well, what is that? That's when they come to you and say, okay, you don't need money as much as you need coverage. So I've got $1 million policy you want to get rid of, got a long life expectancy. I'll tell you what, I will put you on, record you at the insurance carrier for 20% of the death benefit. I'll take over the policy. I'll give you $5,000 now. You'll have life insurance. You'll never make another premium payment as long as you live. And that's what people do who need insurance but don't have the money to pay for it. So we can work it any one of those ways. And that's all happened over time because everybody's different. A lot of people think, oh, they're selling it because they need money. No, they're selling it because they don't have any money and they need life insurance. So this is a way to help them with that.
I got it. So I think I got it, but tell me if I don't got it. All right, I'm going to just give you a hypothetical situation, and see if I've got this right. Let's say I bought a $1 million term policy that's 30 years. And let's say 20 years in, I've got all my kids out of the house. The house is paid off. I've done really well. And now I'm not really sure if I need that policy for the last 10 years, but it's still costing me, I don't know, $2,000 a year. And I go, well, I could just quit paying it because I don't need the $1 million if I die in the next 10 years because I've done well, or maybe I haven't done really well and I don't want to keep paying the $2,000 every year. But the needs have changed. I'm in my 50s or maybe early 60s at this point. Kids are off on their own. You know what I mean? Is that a decent scenario for you to pick up and go on? So if I sell you that life insurance policy and you do like a split, then if I die, let's do 50-50 split. If I die, you get 500,000 and my estate gets 500,000. Do I have that right? Or is that a bad example I just gave you?
Well, no, that's a good example, but the only problem is you would never get 50% of it with it being in your 60s and in good health.
Okay.
So it's all going to be dependent upon your life expectancy, otherwise known as your health, how long will I have to pay those premiums versus what you already have in your hand now. So in a case of a term policy, you have nothing in your hand. So if you were, I'll change your hypothetical.
Yeah.
If you're 70, well, let's keep it a term. If you're 69 years old and you got a term policy and you've got a host of medical issues, there's zero chance you can get new insurance. And if someone did write it for you, it would be so expensive you'd never buy it. So you're thinking, okay, what are my options? See, but you need life insurance. You don't really want to pay the premiums anymore. So that's where the retained death benefit come in. What percentage of that would be based upon your life expectancy, but you would go from having an expensive life insurance policy or worst case scenario, getting rid of it altogether, and now having some death benefit and never make another payment for it for the rest of your life. So that would be somebody that's got you might get maybe another 20, 30, $40,000 in cash, $50,000 in cash plus the retained death benefit. And that'd be a scenario for someone that's in their 60s with health issues. If you're closing in on 80 and you got a UL policy and you've got a 3-year life expectancy, okay, first thing we would tell you is if you can keep this policy, somehow, some way you should, because you have that death benefit coming to you and your family should you need it. But if you don't have that need, then you're going to get a lot of money. Then you might get 50% of the death benefit, 60% because your life expectancy is short. That's the difference. So the shorter your life expectancy, the more money you can expect to receive. When you get to be 2 years or less of life expectancy, that's when you move into the viatical settlement range again. That's tax-free, but you're also very, very sick. We never want you to sell your policy there, but in all honesty, some people just have to.
It makes sense when you say it, but it's kind of weird, right? If you think about it, if you zoom back out and go like you have the chance to get more money out of your life insurance policy the closer you are to death.
Mhm.
Because it makes sense, right? Because what you're doing is you're giving a percentage of your death benefit over to the company you're selling it to, which stands to make money, I guess, the faster you die, right?
Well,
It just works the opposite of most things, right? Because healthcare
but
gets more expensive as you get older, right?
yeah,
Inflation, the longer you live, the more inflation you experience. Your $25,000
when you're
car 20 years ago is now 50. Like it just seems opposite of the way most things work. I get it. It's just weird to think
well,
about it.
think about when most people buy life insurance, right? When they're younger and it's cheaper, and they have all the reasons in the world to need it. They're starting a family. They just bought a house. They just started a business. They're whatever the reasons are. If something were to happen to one of the individuals in the family, the life insurance proceeds help cushion the blow and keep people on the right track, the grieving period, and then getting assembled to get your feet planted back on the ground and going forward. So that's what happens. So when you're 30, 35, 40, you have that life insurance. Now you're 50, 55, 60, and the kids, they're gone. House is paid for. You've retired, whatever the reasons are.
Yeah.
And now life insurance policy is about to become more expensive. People let it go. So the other reason people like life insurance is that when you're in your, is if you're really wealthy, you're buying it for estate taxes. Now you're not a billionaire because then you're just self-insured. You don't need life insurance. But if you are super wealthy and you've got a lot of trust issues and properties and businesses, and you want to make sure that when those handed over to your wife, your children, that the tax obligation is offset by life insurance proceeds. That's the other reason to buy life insurance. So if you don't have either one of them, life insurance is just an expense. Do you really need it for your funeral? Maybe. That's where they can carve out a little retained death benefit equal to like $25,000. So it covers your funeral costs, which most people need because they'll spend it otherwise. So there's just something that every single one of those, we're very rarely working directly with the consumer. We're usually working through an intermediary, but sometimes we work with consumers, and we kind of give the same advice to them. Find an elder law attorney local to you, sit down with him or her, discuss what's happening here, so that they get a game plan for you. Should we get this money? That's what we suggest.
So then who is, and thanks for walking me through that and also taking my scenario and making it better. Who is typically a good candidate? You mentioned ages and financial situations, but who typically is a good candidate to explore this option?
Oh, so I would think someone who's in their 70s, um, regardless of their health, is going to be a good candidate for us. So 75 years or older. Is somebody that we look for. I think you can get too old if you can get in your 90s, and then people start to get fearful that, well, they made it to 90 and they're drinking a martini every day and smoking a cigar. Maybe you don't want to buy this one. And I'm being honest with you, that's what they'll think because they're looking at the medical records. There's no health exam. No one has to go to the doctor or give blood. It's just all based upon your current medical records.
Huh.
So someone in their 70s who doesn't want the policy anymore, because the reason I say that is they're going to take the money and they're going to live. I always say we're going to put life back into life insurance. So you paid for this life insurance. you have had life insurance up until you sell it. So it has been there. So you have used it. You just didn't use it the way no one wants to use. No one to die. Now you get the money out of the policy that you could otherwise throw away. And now you can take that vacation you've always wanted to take. You can retrofit the home. You can buy that car. You can pay for your grandkids' college education. All those things become an option because that money's been freed up. It's no longer tied to that life insurance policy and ultimately to your mortality. It's now put back into the real world and the most important part of it, your world.
If I have a cash balance life insurance policy, and I don't want it anymore, or I don't need it anymore, is it better to just cancel the policy and take the cash value, or should I look at this option?
Well, you're too young.
Well, fair, but
But no,
at some point,
anybody who is 65 years or older that has that exact scenario that you just laid out for us is somebody that should look at a life settlement. Even if we just say, nope, no one's going to make an offer on your policy, because now you can put that in your memory bank and say, okay, I can't do that. So I got to keep the policy and pay the premiums, or I got to just take the cash. Some people use the cash to pay the premiums because they want the life insurance. And then when that runs out, that might be an opportunity to try and sell it with us. So those are, I mean, like I said, it's all snowflake, individual differences, but you should never, if you're 50 years old and you have cash surrender policy and you want to just cash it out, cash it out, because we're not going to be able to help you, especially if you're healthy. But if you've got health conditions, I don't care what your age is, we can help you.
So that's the good candidate, age-based, kind of situation-based, but who is certainly, or most certainly, probably not a good candidate to explore this option? And you mentioned age, right? Is it age or is it other things? Who's not a good candidate? Probably
Age, health, people that have large loans on their life insurance policy. Policy is just upside down, super expensive premiums, long life expectancy, and in addition to that, a loan is probably not a good candidate. So the other thing I'll say is this: when I ask somebody how you doing health-wise, for 32 years, I get two answers. One will say, I'm doing great. So you assume he's in great shape. And you'll call someone else and they say, oh, I'm terrible. I'm in bad shape. Well, what in reality has happened is the guy who's doing great has stage 4 cancer, but today he feels good. But you got the I'm doing great part. And then you got the other one that I'm doing horrible. And she has a abscessed tooth. So that's why we collect medical records, because everyone will always say, oh, you don't understand how sick I am. But you'll see their medical records and really begin to see, like, they don't drink, they don't smoke, they exercise, that all their blood levels are perfect. But they're old, right? Those could still sell, but they're not going to get as much as the opposite of that. Someone who drinks and smokes and has all kinds of health issues and stents in their heart, strokes, all those types of things. Now, here's the funny part. It's not funny, but it is. The person that has all the problems could outlive the person that has no problem. Because that person could find out they like pickleball and then have a heart attack in August, and the other guy could also quit smoking, quit drinking. So that's why the buyers in our marketplace buy hundreds, if not thousands of these policies, because they want to lay out a bell curve, knowing that somebody is supposed to die here, but somebody could die right almost as soon as they bought the policy. And then, of course, you got people that go a lot longer than that. So over time, you'll get that nice mix where they'll pass away at the right time as an investor, because you need both people to succeed in this. You certainly need the client to sell the policy for far more than they can get through an insurance carrier, but you also need the investor to make a return. You don't want them to make too good of a return, but at the same time, you want them to make a return so they continue to be an investor. So I don't root for them, but at the same time, I expect they know what they're doing.
Yeah. Kind of zooming back out a little bit into making this a part of retirement decisions. Why is it important to frame this type of move as one option among many, not necessarily a default solution?
So we like to think of this as a financial planning tool, and with that, retirement. So if you have life insurance, Forget that we even exist. What is the goal of that life insurance policy or policies for you as it relates to your retirement? Why do you have it? And if the answer is, I don't know, then maybe that's a candidate to see if the life settlement option is better for you, given here's how much money you're going to get if you were to successfully sell your policy. What can you do with that additional money? Okay, so that's for the financial planner to decide. It's not for me to decide. So life insurance, we argue that, this in 1911, the Supreme Court decided that life insurance had the same property, had the characteristics of ownership and real property as does your home. So it became basically ability to sell in 1911. So putting that together with it's a valuable asset, so we want to know what it's worth, just like we want to know what your house is worth. So why not go get it appraised, whether you're going to sell it or not, just to know what it's there for, and then decide what do you really want to do with it? What are your goals? If it's not, I need the life insurance because I got this business I'm going to sell to my daughter, and it's in a trust, and she's the trustee, and if one dies, this is the tax liability. So the life insurance proceeds are going to really offset that. Then you're going to keep the life insurance policy. So the goal here is to just make sure that people understand that they own a life insurance policy, and in many cases, it's the second largest asset they own. Of all the assets, including their home, they don't own a home, it's the largest asset they typically own. Let's find out what it's worth, because the life insurance company's not going to tell you. They're going to tell you what it's worth to them to give it, but not what it's really worth to you.
And they want those premiums coming in. What you just said, I've never even heard, but it makes all the sense in the world. If you own life insurance, it's an asset. What do you do with that asset, right? If retirement is correct asset allocation, we always talk about pensions and 401ks and IRAs, and right, you're refinancing your home or downsizing. Boy, I don't know that I've ever heard. I mean, it makes complete sense, Rob, but I don't know that I've ever heard of it as an asset. But you're exactly right. And then you're right. If it's an asset, what is it worth? Not just to you from a utilitarian standpoint. What is it worth in the open market? Right. Same thing you said. You made the analogy with the house. Sure, a house is worth utilitarian value. I live in it. It shelters me from the storm. I understand it. I know when I replaced my roof last, and what that the cranky heater is. But it's a place for me. But it's an asset, and I can either the value to me is different than the value is open to the open market. It's the same thing with life insurance. Never thought about it that way. It makes a lot of sense.
Well, I have to think of it that way because that's the only way it makes sense to people. So like, and they can put them in a position of owning something like a home, and they know how valuable that home is. I want them to realize their life insurance policy is almost as valuable because they can't live in it, but they can take the money and improve the house that they're in that we talked about here, and use it to buffer that to make it even better for you as you age forward, going out 10, 15 years. And then you're leaving that house to your children, your grandchildren, as
Yeah.
opposed to
So
just letting it go.
you mentioned, trips. You mentioned, right, making sure you've got no step showers, that sort of thing in the home. How do, in all your 30 years, how do people typically use these proceeds when it does make sense for them? Is it income support for, monthly cash flow? Is it long-term care? You mentioned assisted living or memory care, which is, I mean, geez, the prices on those things longer term for memory care, nuts. Or just simplifying finances and getting stuff off. Like what do you normally see?
So there's no one answer. So
Okay.
it's all the above. I'll give you an best example. So one of the first client I got to know, going back into HIV/AIDS, he was he had some type of a hip surgery, and he got AIDS through infected blood. So he was going to die. It was a matter of fact, this was like in 1995. He had, I think it was, I don't know exact number, I'm just making it up at this point, 7, 8 kids, all kinds of grandkids. So he sold his policy and he was like near death, but he still was in good shape to do stuff. He could still do stuff. He had good days and bad days. He paid for an entire week at the Wilderness Lodge in Disney World. He sent me pictures. Everybody came down. grandkids, the T-shirts, the matching T-shirts, all that. Big smile on his face, all paid for by the proceeds of his life insurance policy. They didn't want anymore because he just couldn't. He wanted to do this. This is what he wanted to do. So the memories that obviously he took with him to the grave, and then the grandkids and the kids will never forget that because they were a family that wasn't something that they just had available cash to jump on a plane and go to Disney World. You mentioned prices, how much they cost for things. You mentioned memory care. The other day on a podcast I was on with another guy, he said this to me, which I'm going to steal, which is if you can go into a memory care facility in South Florida, which we're both from, he thinks it's cheaper to go to the Four Seasons and check in for the rest of your life than it is to stay in the memory care facility. He said that.
Yeah, I've heard that before. Yeah, like price out a year worth at the Four Seasons. It's likely cheaper.
So, because you have no problem getting people to come take care of you because you're at the Four Seasons, right? You get your sister, your brother, your daughter, your cousin. They're all coming because they're there. And it was it's sad, but that's the truth. So that's why this aging in place has become like the new thing, because as the wealth advisor, you're going, your home is paid for. Your tax basis is little compared to what it could be. The person who buys this is going to pay 7 times the taxes. So it's more affordable for you to live there than it is for them. So stay there, And then these homes are literally becoming a type of a style of home that is for sale. They'll say like aging in place home, and they'll have all these homes that have been already redesigned, the bigger driveways and the ramps up and all that stuff. So people are looking for them to do the same thing, to move down here, get out of New Jersey, get out of wherever they're getting out of, to come down here for the weather. Of course, we were cold a couple of weeks ago, but you just never know. I wish there was a simple answer to everything. Everybody's got a different reason for what they want to do with it. Mainly, it's just I try to give you the answer. I try to give you the problem, the math problem. Is it better to keep paying the premiums for a life insurance policy because there's a need in force and do you have the money to do it? Or is it better to sell it for this much and do A, B, or C, depending on what you've been advised by your financial planner? And I think most of the time we give, as I mentioned, I'm on the board, chairman of the board of LISA. And the last 4 years, we'll do a 5th year. We do a data collection study where we ask each provider, which are the buyers in the industry, how many deals did they buy? What was the aggregate face? What was the aggregate surrender value? Right? But how much money did the client get? And every year we conclude that they get a percentage over and above cash. In the last 4 years, the average is 6.5 times. So if you get $100,000 in cash, we're going to give you $650,000 in a settlement. That's to you.
Wow.
That's significant. That's not like getting $18 more. That's $550,000 more on average. So we're proud of that. We're also proud of the fact, and here's another good reason, is we've had 0 consumer complaints as an industry in the last 5 years. And it goes, wow, that's incredible.
Yeah.
But I tell you why, because it's not that I'm going to kind of water it down. We're giving people more money than they would get with any other option they have. So naturally, they're going to be happy. We still, people, when they might not get the offer they want, or they get an offer that's less, they're still happy because we gave them an answer. They're given an answer on something they didn't even know they could do. And that's why we like it.
You've been deeply involved in regulatory and professional standards. What protections are in place today for consumers?
So first and foremost, their privacy. So their medical records. We're not intrusive. We're not coming to your house. We're not taking your blood and all that. Your medical records are uploaded through. Everything goes out through an encrypted server. So the information is shared with the buyers back and forth. No one leaks that information out. Pretty safe, in the sense of the world today. We can't argue that there are doctors that will still send their clients' medical records in the mail, but I can't stop that. We try and explain to them, could you could you try and scan those and email
Yeah.
those to us? But that that's for another day. Um, they have a 15-day right of rescission. The most important thing in the transaction is they don't know who we are. They don't know who my buyer is. So we went out early on. I was a part of this. But we decided that we would put a third party escrow in the middle. Okay. So they would hold the money that's been promised the client, and they would act as the custodian of the change of ownership from the carrier so that the buyer knew that they own the policy, and they would go through everything and make sure it's perfect. Everything's exactly as planned. And then once they do, policy's released and so is the money. So and then of course they said the 15-day right of rescission kicks in. We have had 4 rescissions since I've been in this business.
Oh, wow.
Unfortunately, all 4 of them were people who died in the rescission period. So naturally, that would make sense to rescind.
Yeah.
One of them actually passed away 2 days after the rescission period, but we considered the weekend that it happened, and we said that's too close. Give the money back.
Yeah. Just do the right thing, right? Yeah.
Right, and that's protection. That that's the really thing you need to make sure is I don't want to give my policy away and not get paid. So we have too much at stake not to let that happen.
Yeah, and I said this before we started recording, but every 2 years I'm licensed I've been licensed since 2001 for life and health as part of what I've done in the past. And I just keep it up. And every year I go in, I do my continuing education credits, and I see the licensing for this particular piece, and I'm always really intrigued by it. I'm like, well, what is that? I mean, I've seen this every 2 years for 27 years. Why does licensing and disclosure and experience matter so much in this space?
Well, the contracts that we give.
I mean, right? You do have to be
a cluster.
specifically licensed for this. You can't just be like I sell car insurance and I do this. I mean, this is very specific stuff.
So you have to be a life and health agent, right? Excuse me, life and annuity agent. You don't have to have health, just life and annuity. And then you get licensed, and then reciprocity allows you to have those in each state. What happens is, because there's always a fee element of this with the Department of Insurance, is then you have to appoint yourself in Florida. I self-appoint myself, give myself viatical and life settlement authority. So I'm a life agent with viatical and life settlement authority. Without having those two, I cannot do this business in the state of Florida. Now, other states they won't have appointments, but you'll have to have another way they phrase the same thing. In some states, they don't care. Just life and health, you're fine. 45 states regulate it. 43 specifically life settlements. The other 2, Michigan and New Mexico, regulate only viatical settlements. South Carolina is the largest state that doesn't regulate it. That's got the most clients in it. We treat each state as if it is licensed. So we use the NAIC Model Act paperwork. So the same contracts are pretty standard. Lawyers did get involved, and they're a little longer than they need to be, but we're trying to work them down. But it's in there, just something that they have a right. If they have been upset with us, they can call their Department of Insurance, scream and yell if they want. It's never happened, but they can. But generally speaking, we want to move the transaction along as quick as we can. So probably a question you're thinking in your head, how long does it take? I tell people 90 days, start to finish. Could happen sooner. No one ever gets mad that I said 90 and it happened in 60. They're not like, well, you said 90. Why am I getting in 60? Never happens. But if I said 60 and it took 62, I'd hear about it for 2 days.
I'm obviously this sparks questions in my mind, and I've got my own life insurance policies floating around my head. And I say policies with an S because there's more than one. Because as I just said, I've been in the insurance space for a really long time. So when guys like you and me who have been in and around insurance know that bad things happen to good people, and so we all tend to be a little bit overinsured. I mean, we all joke about it, but it's true. We probably don't need all that we've got, but we see it more than anybody else really does. How often should people revisit old policies?
Every year. Once a year. More if you
That's
can,
all.
but I would do it. We call it annual policy review. So if you've got a policy that, whatever, try and do it in advance of when you have to make the next premium decision. That's something you should talk with your financial planner about. Because in many cases, you may have a policy that for some reason just isn't working right. I mean, I have one right now that's blown up. Somebody sold this person this policy to this individual, and then they told him to take a loan out. And now the premium is like, it's hundreds of thousands of dollars. And they're like, I don't have it. I go, well, you're gonna have to do something, you know. So we're working on that. They're not old enough yet, but we're trying to get them with the right person and say, okay, fix this, fix this. I've got some really good insurance contacts that can fix bad policies, but they're not always fixable. Generally speaking, when you're younger and you get a few bucks in your hand and they don't know and you don't know what you're doing, like most people, and the guy says, hey, you should buy this policy because you're going to pay this little bit of money. And then every once in a while, your policy is going to go up and then you're not going to make the premium payments more. It's going to pay for it itself. Those were called vanishing or disappearing premiums. They still are out there. They call them something else. They never work. They always need more money. And you just throw money away. Now, granted, I always tell people with life insurance, you were covered. Had something happened to you, you would have been paid the death benefit. So you have to look at it that way. You weren't ripped off in the sense that you owned a condo you never got to visit and never went to. Life insurance, just like with the car insurance, right? You don't want to go get in an accident in a Target parking lot because you got insurance, but it's there if you need it.
Yep.
So that's what life insurance is. It's a luxury, but every year, for sure, you should automatically, if you're listening and you haven't talked about your life insurance in decades, seek counsel from your trusted advisor and go through your policies. You may be paying premiums that you don't need to pay. More like I tell people all the time, most of the premiums that you're told to pay on everything but term is too much. You don't need to pay that. You can pay less all the time.
Huh.
When we sell a policy in these life insurance situations, the new owner, they don't pay what the premiums the carrier told them to pay. They pay the cost of insurance. They pay the minimum necessary to keep the policy in force. And there's ways to ask for that illustration. You can get that illustration. There's shadow accounts. You can find out there's other lapse-based pricing tricks they've done. You can pay, if you were supposed to pay $3,000 a year, you might pay $1,800 for this, and everything's the same. Just paying less money. No, you're not growing your cash value either because you don't really need to do that. You rather keep your own money like a term. So they're not all bad,
again,
but I'm saying there's a lot of bad ones out there.
I've never heard that, and it makes all the sense in the world. I mean, in my space, the Medicare space, right? I talk about annual housekeeping. That's step 5 of my method. It's annual housekeeping. It's once a year. You got to look at it. I've never heard anybody tell me to, like, literally never heard anybody tell me to look at my life insurance once a year. I mean, I'm sitting here listening to you going, good Lord, how long have I had life insurance? And when was the last time I looked at it other than just pay the damn premium once a year or twice a year?
Mm-hmm.
Never. What am I doing wrong? Well, it sounds like I need to make this a bigger part of my own financial planning.
Well, that's right. Because now that you know what we talked about, and you're a smart guy, right? You wouldn't be doing what you do as successfully as you do it if you weren't. Now that you know it's there, you'll think every time you see that commercial on TV or every time you're taking your test, right? Or every time you think about the life insurance premiums, if you just see something in a magazine, you'll think, I should go look at my policy. My policy, for example, not to give anything away, but I'm 61. So when I'm 62 in June, I have to make a decision by the end of next month to keep my term policy to convert it to a different policy. And let me just share with you, the premiums are only going to be 7 times more expensive.
Only
a year. Only 7 times more. Now, what do you think happens to most people who have a premium that goes up 7 times more a year? They let it lapse.
They're not going to pay it. They let it lapse.
So,
how do people go? Where can people go to learn more? How do they find this? If they don't have a financial planner, or they say something to their financial planner and they get crickets from the email because they don't know how to do this. Where can people go to learn more about this with that education first, no pressure approach?
So first and foremost, I would recommend they visit our association website, which is www.lisa.org. That's LISA.org. My website is www.lisettlements.com. You can call me on my cell phone, 954-599-4433. I promise I'll call you back if I don't answer because I'm afraid you might be a spam call. But leave me a detailed message and I'll get right back to you, I promise. And my email is rob@lisettlements.com.
And I'll put all of that on the show notes on the episode page on the website. So if you're driving and don't want to hit that 10 or 15-second back button 15 times and trying to remember it, it'll be on the show notes. Just go to the page. Rob, this has been super helpful selfishly for me, which is also part of the reason I do this show, because I learned so much. And you really have
Right.
taught
Well,
me a bunch of things. Yeah, I didn't know. And so thank you. And hopefully, and I got to imagine everybody listening or watching has got to think the same thing. A lot of big takeaways and ahas for me in here that I just frankly didn't know about. So I appreciate the way you approach the conversation. And it's, you're not pushing a product. It's about understanding options, protecting people from bad decisions, making sure families aren't forced into choices they don't know even existed. And, the last thing, you said clarity, right? Assess it, do a free, get it valued. I mean, that can reduce stress, improve decision making, supports better outcomes over time. And you don't have to do anything. You just have to go check the market. So thank you, Rob, and to everybody listening or watching. Thank you. Asking informed questions about insurance, retirement income, long-term planning is how you can protect your wealth, your wisdom, and support your wellness as life evolves. I hope you've enjoyed this show. I've enjoyed doing it. And like I said, learned a lot. But also thanks for being a part of this community. And thanks for joining me on the Matt Feret Show. We'll talk to you next time.
Thanks for joining me on the Matt Feret Show. If you enjoyed today's conversation, please share it with a friend and subscribe on Apple, Spotify, and YouTube. If you're on Apple or Spotify, a quick rating or review really helps more people discover the show. For more resources, visit themattferetshow.com and sign up for the Matt Feret newsletter. And if you or someone you care for needs Medicare guidance, book a no-obligation consultation at brickhouseagency.com. Helping people make smarter choices as they age is my passion. This show is here to light the path towards your wealth, wisdom, and wellness. Thanks for being a part of the conversation.
The Matt Feret Show, related content, publications, and MF Media LLC is in no way associated, endorsed, or authorized by any governmental agency, including the Social Security Administration, the Department of Health and Human Services, or the Centers for Medicare and Medicaid Services. The Matt Feret Show is in no way associated with, authorized, approved, endorsed, nor in any way affiliated with any company, trademark names, or other marks mentioned or referenced in or on The Matt Feret Show. Any such mention is for purpose of reference only. Any advice, generalized statistics, or opinions expressed are strictly those of the host and guests of The Matt Feret Show. Although every effort has been made to ensure the contents of The Matt Feret Show and related content are correct and complete, laws and regulations change quickly and often. The ideas and opinions expressed on The Matt Feret Show aren't meant to replace the sage advice of healthcare, insurance, financial planning, accounting, or legal professionals. You are responsible for your financial decisions. It is your sole responsibility to independently evaluate the accuracy, correctness, or completeness of the content, services, and products of, and associated with, The Matt Feret Show, MF Media LLC, and any related content or publications. The thoughts and opinions expressed on The Matt Feret Show are those of the host and The Matt Feret Show guests only, and are not the thoughts and opinions of any current or former employer of the host or guests of The Matt Feret Show, nor is the Matt Feret Show made by, on behalf of, or endorsed or approved by any current or former employer of the host or guests of the Matt Feret Show.